The global economy is currently unstable, and financial markets are uncertain due to recent disruptions around the world. As a result, many people are feeling fearful and anxious about their finances and ability to maintain their standard of living, especially in these challenging circumstances. In an attempt to protect the value of their money, people are flocking to buy gold, believing it to be one of the safest and highest quality assets available. This is especially true in emerging markets that are facing high levels of inflation and increasing pressures on their currency. But the question is, can gold truly be used as a hedge against inflation and exchange rate fluctuations? To answer this, we need to first understand what drives the price of gold, both domestically and internationally. Currently, the world gold price is hovering around $2,000 per ounce. Interestingly, while the U.S. Federal Reserve has raised interest rates to record levels, it seems counterintuitive that there is a clear gap between local and international gold prices in many markets. This and more, we will find answers for it today. Throughout history, gold has been treated in two ways by people. Firstly, it is a commodity that is bought and sold at the current moment. And secondly, it is money that is used as a means of exchange. Until the early 1970s, in August 1971, President Richard Nixon canceled the gold standard, or the Bretton Woods system, which was the cornerstone of the global monetary system. Since then, the role of gold in the monetary system has diminished, and everyone has been treating the yellow metal as a commodity. Although it is primarily a commodity, like oil, gas, copper, wheat, and others, gold has unique properties that distinguish it from any other commodity in the world. I do not mean its chemical or physical properties here, but rather the fact that its market is different from any other commodity we know of. For example, we all know that what primarily moves the price of a commodity like oil is supply and demand. If OPEC decides to cut its production tomorrow, oil prices will skyrocket because the supply in the market will significantly decrease. On the other hand, if the world is forced to shut down its economies, as happened during the coronavirus pandemic, oil prices will collapse because demand is higher, making oil an incredibly sensitive commodity to supply and demand. However, these factors are not present in the gold market. Firstly, gold is not consumed. People buy it to keep it as a store of value. Even the part of gold that is used in industry is recycled, which means it re-enters the market. Therefore, some estimates suggest that all the gold ever mined in human history is still with us. Secondly, gold is a commodity that people keep forever, and the amount of gold stored in vaults worldwide is limited. That gives significant power to gold producers in the market. Therefore, gold is not affected by supply and demand dynamics in the same way as other commodities. In 2022, for instance, the world produced 3,100 tons of gold, while the gold already in our possession is approaching 209,000 tons. As consumers who own the 209,000 tons, we have much greater power to control gold prices compared to producers who only produce just over 3,000 tons. Therefore, we can say that the traditional supply and demand model does not fully apply to gold prices, and this is a major mistake made by some analysts. Those who try to predict gold prices based on the volume of new supply from mines or on the demand from central banks. For example, what exactly moves gold prices? One thing only: people's expectations. These expectations can be divided into two categories. The first is people's expectations of others' actions, and the second is people's expectations of the future economy. Let's take them in order and try to understand how people's expectations of how others will behave can affect gold prices. As consumers, we can exert significant influence on gold prices. However, our actions are driven by our expectations of what others will do with their gold. If we believe that others will buy gold, we may be more likely to hold on to our own gold, which can drive up prices. On the other hand, if we believe that others will sell gold, we may be more likely to sell our own gold, which can drive down prices. Therefore, it is important to understand how people's expectations can affect the behavior of other gold owners and ultimately influence gold prices. In terms of people's expectations of the future economy, this can also have a significant impact on gold prices. If people believe that the economy is going to improve, they may be more likely to invest in riskier assets such as stocks, which can drive down gold prices. On the other hand, if people believe that the economy is going to decline, they may be more likely to invest in safer assets such as gold, which can drive up gold prices. In his renowned book, The General Theory of Employment, Interest, and Money, published in 1936, the British economist John Maynard Keynes explained the concept that the financial markets are governed by the logic of beauty contests or the principle of beauty counts. He used a humorous example of such a contest to illustrate his point. One newspaper held a beauty contest for its readers. The newspaper published a picture of 100 faces and asked its readers to select the 6 most beautiful faces in their opinion. The winner of the contest was the reader who picked the 6 faces that were chosen the most frequently by other readers. If we were to hold this contest today, many of you might find it challenging to choose the most beautiful faces based on your personal preferences. Keynes argued that this strategy is flawed for someone who wants to win the contest. The better strategy is to select the faces that you anticipate others will find attractive, not the faces that you personally prefer. In the end, the key to winning is to choose the faces that are repeated the most in other readers' choices. If you are very clever and want to increase your chances of winning, you should choose the faces that you think others will not find beautiful, but you do. Your primary goal is to win the contest, not to select the most beautiful faces according to your own opinion. Your viewpoint is not valuable in this context, and if you lose, it will cost you money. Let me try to simplify it for you and give you an example. Consider the process of taking the subway. You want to get on a train that is not too crowded so you can be comfortable. Now, when you go to take the subway, you have several choices of which train car to enter. Let's say the train has 8 cars. If you're like most people, you'll probably just get on the first car that's in front of you, because that's the easiest one. That's the first level of direct thinking. Your brother, on the other hand, knows that a lot of people prefer to get on the cars closest to the entrance, so he'll wait on the platform for the last car, because he assumes it won't be as crowded. That's the second level of thinking. Your father, who's a wise man, knows that both you and your brother are likely to think like that. So he'll avoid the first car, which you entered, and the last car, which your brother entered, and he'll get on a completely different car. That's the third level of thinking. Simply put, your father thought differently than the others, and anticipated the expectations of others like you and your brother. This reasoning governs the gold market. The price of gold is determined not by your personal estimation, but rather by the collective estimation of its value. Your local market may not make sense to you and may seem overblown, but that may not matter as long as other participants in the market see things differently. As an investor, you have 2 options when faced with this dilemma. You can either stick to your beliefs and abstain from entering the market because you're convinced that the price is too high, or you can accept that your perspective may not be the only one and that there may be others who see value in the market at its current price. It's important to understand that market prices are not determined solely by one person's estimation of value. Rather, they are the result of the collective evaluation of all market participants. So, while you may think that the local market is illogical and overpriced, it may still be a good investment opportunity if others are willing to pay that price. Ultimately, you need to make a decision based on your investment goals, risk tolerance, and personal beliefs. However, it's important to consider the perspectives of other market participants and to remain open to the possibility that you may not always have the right answer. On that note, it was the reason a major investor objected. In a speech back in 2011 which sparked the story, he explained the rationale behind his objection to investing in gold. He told the shareholders who were with him that there is a category of assets that do not produce anything, and people buy them in the hope that someone else will buy them from them in the future. For a higher price, he continued, and mentioned the most famous asset in this category, especially among investors who are afraid of other assets, which is gold. However, gold has 2 important disadvantages. Firstly, it has limited uses, and secondly, it does not reproduce, which is what motivates most people who buy gold to believe that the number of people who are afraid of it will increase and that this will drive up the price. Therefore, people are more attracted to it and believe that a rise in price is a sign of its value.
In simple terms, there is an opinion that many people may agree or disagree with. But the speaker's words raise a very important question. 2 groups may be walking on the same path, but with different motives. Ordinary people buy gold out of fear while investors exploit people's fear for their benefit by buying gold, expecting that people will remain fearful in the future and continue to buy. So, the question is, what is the source of this fear? In normal circumstances, individuals treat gold as a commodity, buying it for its practical use as jewelry. However, during tough economic times, people start to view this metal as a hedge, a means of protection. For example, in 2022, the local price of gold in Turkey increased by about 40 due to the high demand for gold in the last quarter of the year. Demand for jewelry in Turkey dropped by about 32 on an annual basis. What caused this significant increase in demand? In short, the main driver behind the high demand for gold among Turks was their fear and their attempt to hedge against the risks of the lira's depreciation, which had already declined in recent months, and the inflation rate, which had reached record levels during the same period. The Turkish central bank, which was the largest purchaser of gold among central banks in 2022 to control gold prices, has recently started selling part of its gold reserves in the local market, according to Bloomberg. As of April 27, 2023, Turkey's central bank gold reserves decreased by 9 over 7 weeks, adding to the problem of current gold prices in Turkey and other countries facing similar conditions. The problem is not only that the value of gold has decreased and inflation has increased, but that people are afraid that this will happen in the future. This is why we say that psychological effects are the main drivers behind gold prices. People's fear and pessimism about the future stimulate them to hedge against their fears. What exactly is hedging? When buying gold, there are two main factors to consider. Inflation, which we refer to as internal conversion or
internal hedge,
and currency fluctuations, specifically the decrease in the value of the local currency, which we refer to as
external hedge.
Let me explain how inflation reduces the purchasing power of money. As you may know, the value of money decreases as inflation increases. In this case, some people try to avoid the risk of the decreasing value of their money by investing it in a safe haven, which in our case is gold. Hedging, in simpler terms, is a way of protecting oneself against financial losses. When people invest in gold, they are essentially hedging their financial portfolio against inflation and currency fluctuations. Gold is a popular hedge against inflation because it typically retains its value over time. In times of economic uncertainty, investors tend to flock towards gold as a safe haven asset, causing its price to increase. Furthermore, gold is also a hedge against currency fluctuations, specifically the decrease in the value of the local currency. In countries where the local currency is devalued, people turn to gold as a way of protecting their wealth. By investing in gold, they are essentially converting their money into a more stable asset that is not subject to currency fluctuations. Inflation and fluctuations in currency exchange rates can have a significant impact on people's savings and investments. One way to protect against these risks is by investing in gold, which has long been considered a safe haven asset. But does gold really serve as an effective hedge against inflation and currency fluctuations? If inflation were to rise by 10, and at the same time the value of gold held by an individual were to increase by 10, the person's wealth would remain relatively unchanged. This is because gold would have preserved its value, acting as a hedge against inflation. Similarly, if the price of gold were to increase by 5s, while the local currency's exchange rate decreased by the same percentage, gold would serve as a partial external hedge against currency fluctuations. Several studies have investigated the effectiveness of gold as a hedge against inflation and currency fluctuations. In a 2021 study titled Dynamic Safe Haven Properties of Foreign Exchange Rates, 3 reputable researchers analyzed data from 15 countries between 2009 and 2020. They found that when the local currency faced unexpected shocks, gold moved in the opposite direction, making it an effective hedge against foreign exchange rate risk. Another study titled Is Gold a Hedge Against Inflation? Analyzed inflation data from 4 countries, the United States, the United Kingdom, Japan, and Switzerland, and compared it to historical gold prices. The researchers concluded that gold can serve as an effective short and long-term hedge against inflation, although the results varied somewhat. Overall, Gold can be an effective hedge against inflation and currency fluctuations. As former UC Berkeley business professor Roy Jastrom wrote in his 1978 book, The Golden Constant, gold is a suitable hedge against inflation in the long run. However, like any investment, it is essential to conduct thorough research and exercise caution before making any decisions. In the end, some people buy gold at prices that reflect their expectations of future inflation. Local gold exchange rates, such as those in Turkey, indicate how people perceive the future of the currency and inflation. This is a unique indicator, as former Federal Reserve Chairman Alan Greenspan testified before Congress in February 1994, stating that gold prices are a very good indicator of future inflation rates. People's expectations of future inflation and exchange rates are one of the reasons for the gap between local and global gold prices, which widens as expectations become more pessimistic. The more demand for gold in the local market, the greater the gap between local and global prices, especially if there are restrictions on gold imports. The dangerous thing is that these expectations can often be exaggerated or overly pessimistic. If things are normalized and inflation and exchange rates stabilize at reasonable levels, gold will revert back to levels closer to its global price, and people who invested in it will have lost out. The unfortunate reality is that the panic-induced gap in gold prices can lead to irrational behavior and an increase in gold prices to unjustifiable levels. This herd mentality is not grounded in logic or reason, and the resulting price gap contributes to economic instability, exacerbates existing problems, and increases the likelihood of risks that people are already trying to avoid, such as inflation and exchange rate deterioration. Therefore, investing in gold under such circumstances is a very risky game that can destroy the investor. Worse still, it can negatively impact the economy and exacerbate existing problems, increasing the likelihood of risks that people are already trying to avoid, such as inflation and exchange rate deterioration. As always, I have a question for you. What is the difference between hedging and investing? The goal of hedging is to neutralize risks, while the goal of investing is to grow capital. Can gold be considered an investment? I will follow your answers in the comments at the end. If you enjoyed this article, please support us by following us.